All right. Hello, everyone, and welcome to the latest installments of the Livingbridge webinar series. Today, we're bringing together our global team to chat through why we believe there's tremendous value in building a strategic M&A capability and to explore some of the successes and pitfalls we've encountered along the way. A bit of housekeeping before we jump in. Regarding any tech issues, if you can't hear us or are having any issues, please drop us a message in the chat box. Regarding any questions, we're going to reserve for the end, so please jot them down and we'll run through during Q&A. In terms of timing, we should run about 45 minutes. As a quick introduction, my name is Kurt Gahn, and I'm part of Livingbridge's US and new investment team, where I focus on both partnering with our global investees in their efforts to scale into the US, while also having the privilege of meeting with really interesting entrepreneurs and business owners who may be looking for a partner in the next phase of their journey. Previously, my background is in strategy consultant, and most recently, building and leading a corporate development team for a PE-backed business. Joining me today from London are Louise Kingston and Louis Graham. Louise?
Thanks, Kurt, and hi everyone. I'm Louise Kingston. I'm an investment director at Livingbridge, where I spend most of my time working with our investee management teams after we've invested to help them design and resource up to plans. I've sat on the board of more than 10 businesses as a non-exec director for Livingbridge and led or supported more than 20 transactions in my career to date, including a combination of a range of platform and bolt-on acquisitions and exits.
Hi everyone, I'm Louis Graham and I lead the direct origination team, which is responsible for sourcing investments for Livingbridge. This involves us identifying and researching thousands of companies each year, leveraging our proprietary sourcing technology. We then approach and meet several hundred of these with the aim of eventually completing a transaction. And I've used our technology and expertise to support around 15 companies with the pre-diligence phases of buy and build strategies.
Great. So let's quickly run through what we'll be discussing today. Louise is going to kick things off by walking us through why we place so much value on building a strategic M&A capability. I'll run through how we think about building M&A strategies and theses. Louis will run through how we approach sourcing and origination and leverage a variety of proprietary and off-the-shelf technologies to create competitive advantages in the market. And Louise will close things out by running through our approach on diligence, transacting, and how we view synergies and value creation. Louise, want to kick things off?
Sure, thanks, Kurt. So first of all, what do we mean by an M&A or a buy and build strategy, and how does it work to create shareholder value? So by this, we mean any growth strategy that involves starting off with a platform company and using that as a platform to scale up by acquiring and bolting on one or many other companies. A buy and build can take lots of different forms. And one simple way that we think about the spectrum of deal types is the cookie cutter roll-up model at one end through to the transformational acquisition model at the other. We do both of these types of buy and build at Livingbridge, and actually in reality most buy and builds are somewhere between the two extremes. The roll-up is a common model in lots of really highly fragmented sectors like dentistry, vets, schools, support services, for example, where there are thousands of small operators and a really compelling strategic and operational law into one larger business, because that gives you the scale to do things that the individual small customers couldn't do companies couldn't do on their own, like go after much bigger customer contracts or achieve economies of scale in purchasing and that sort of thing. A transformational acquisition strategy, by contrast, is where you are using M&A to put together two or more businesses that might actually look really different, but in combination, the whole is worth more than the sum of the parts. And we'll come on to why that might be. Buy and build has been one of Livingbridge's most successful value strategies over the years. And actually, had a look at the stats this morning, about a third of the investments that we have made have been used as a platform for further acquisitions. So over the years, we've backed more than 40 platforms, roughly split 50-50 between roll-up types and transformational types. And each of those made an average of about 4.5 bolt-ons per platform. So I'm pleased to say that most of these have been very successful, but the journey hasn't been without some failure and setbacks, and we'll pick up the learnings from all of that in the next 30 minutes. Oops, come back. So look, how does a buy and build actually work to create equity value? So very simply, when it's done well, it's a little bit like alchemy on paper. So you buy up all of these small businesses at one price, put them together, and then the enlarged group is worth more than what you paid for the individual parts. That's the theory. The reasons for this, when it works well, are mainly around, first of all, scale. So the fact is that certain investors are only going to be interested in businesses making above a certain level of profit. And there are various key thresholds. So EBITDA of at least £1 million is usually the minimum for a private equity buyer to be interested. And then as you scale up past 5 million, 10 million, 20 million thresholds of EBITDA, you pass through different categories of private equity investor, usually becoming increasingly more attractive to a wider range of professional investor. So one example of a quite well-known value arbitrage model, take dentists, for example, where individual practices today trading maybe making a couple of £100,000 profit per practice, trade in the open market for about 5 to 6 times EBITDA, whereas the really successful big groups are trading for double-digit EBITDA multiples. So clearly a big value difference there. The second point here is about synergies, both cost and revenue synergies. Now, there aren't always synergies in doing a buy and build. In fact, there can sometimes be the opposite, in that part of the strategic rationale is that you want to invest more into some aspects of the overall value proposition that mean the margin of the group is lower than the margin of the individual acquisitions. But look, the economics of the model are that if you can improve the growth rate of the businesses you're putting together, or the profit margin of the platform and the bolt-on after combining the two, then you will have created value that previously didn't exist. Next up is the use of leverage, and by that I mean debt. So if you can use debt or the future cash flows of the business that you are acquiring to fund the purchase price of that business, then clearly that you can use that to drive up the shareholders' equity value. And then this last point, coming back to where Kurt started, in his next couple of slides, the whole thing really does need to hang together in a strategic sense and make sense together as a group, or any buyer of the combined entity is just going to take a look at that business and see a bunch of small businesses that really should just be valued as a group of small businesses.
Great, thanks, Louise. So to set a bit of a baseline on our experience, as Louise alluded to, over the past 25 years, we've completed over 140 bolt-ons. And as our organization has grown, we've purposely developed global capabilities to support M&A as a means not only to acquire customers, market share, or new products, but to also serve as a beachhead into new global markets. As you'll see on this slide, we'll reference back to a few of these businesses where we've partnered with the management teams on a variety of strategies across the globe. So before we jump into strategy, let's briefly ground ourselves in how we think about the corporate M&A lifecycle. Simplistically, corporate M&A can be viewed and managed very similarly to a large B2B sales process. You start by building a strategy in key focus areas cross-functionally across key stakeholders, then build and prioritize a pipeline based on those theses, qualify those targets through the pipeline via diligence and engagement, and eventually transact or close the deal. And just like traditional sales cycles, where your customer success or account managers ensure value is captured, in M&A, a project management team must also ensure your acquisitions are properly integrated and synergy value is realized. So as mentioned on the previous slide, we always aim to take a thesis-driven approach to M&A. Typically, within the first 100 days of our investment, we aim to sit down with our management teams as part of a strategy day to map out their current business models and understand which areas of their strategic roadmap could potentially be accelerated through M&A. At a high level, this can be in the form of a customer acquisition, which are typically much less risky and simply acquire market share while defending against competitors, or product acquisitions, which can be a bit riskier, disruptive, and costly, but rapidly enable a business to fill a product gap or enter a new market, and potentially substantially increase the value of that business. Psionic is a great example of this. In 2017, we invested in Psionic, a specialist financial markets consultancy, at the time largely focused on the UK markets. Early in our investment, actually probably even before our investment, we developed a strategy and began building a pipeline of targets with the leadership team, which would drastically accelerate the company's growth by acquiring both synergistic products, customers, but also providing a beachhead into new global markets. So now after 2 acquisitions, the company has more than tripled in size over 2 years, is now in 9 countries across the globe, with a new anchor office in New Jersey, serving the New York City market. The business also offers multiple new products, which are now being cross-sold into its existing banking customer base. A really neat example of how we've worked with the management team to quickly execute on a defined strategy. Louis will now walk us through how we translate this strategy into a pipeline and then take action on it.
Thanks, Kurt. So this process workflow down the left-hand side should be pretty intuitive, but it is worth spending some time on this. A lack of structure on this could lead to a loss of momentum later on in a M&A process. So the first step on defining criteria is this is all about translating your strategy into individual criteria that companies can be mapped and ranked against. Some high-level categories might be product or customers, geography, or financials and ownership. And within each, several metrics that need to be true for a company to be an interesting prospect, or that would make one company more interesting than another. And each of these metrics should fit with the overall strategy. And be aware that for some of these metrics, the data is unlikely to be available before signing an NDA or entering the diligence phase. But there should be enough data available to create and rank a pretty accurate pipeline of targets from the start. So for target identification and prioritization, I think the key to this is leveraging technology. The main things to think about here are gathering data using various data sources and storing that data in a CRM. So once you've defined your metrics, you need to use data sources to identify the companies and to gather the data for your metrics. So building an initial list of companies might involve you using a combination of your existing contacts, industry body members, customer partner networks, and a bit of old-fashioned Google, and then prioritizing them into an action list. To that, you'll need to populate your chosen metrics for each company. So you might get those from data sources for financials and ownership, or website and search traffic volumes, news flow, and probably using the company's own website to find information on product, customer, and geography. When Livingbridge, when we support companies with sourcing, we primarily leverage our proprietary platform, which is constantly pulling and evaluating data from these sources and a number of others on a constantly growing number of companies, currently around 600,000. And then leveraging this CRM, I think there's 4 things to capture in a CRM for M&A. So the obvious one is the companies and the metrics you're capturing for them, the key individuals and their contact information, and then any approaches and meetings that you've had. I think it's useful to capture that and capture the content of the discussion. so that you can revisit it. And as the pipeline grows, it's easy to see where you are with each company. And then lastly, having some sort of scoring system to allow you to easily segment your pipeline. So some common scoring metrics are quality, measured as how well a company meets your target criteria, likely time to completion, so that you can segment your pipeline by time, and the quality of the relationship that you have, measured as something like, do we think they want to do a deal with us specifically? And you can try and capture these things in Excel rather than a CRM, but very quickly that's going to become quite hard to maintain that data quality, especially if you do multiple rounds of mapping and you're tracking companies for a period of months or years. A CRM is just a much better way from the start to do that. And then for the outreach and meeting stages, having seen this not be done well sometimes, I would argue it's important to decide early who's going to do these stages. If they're done well, they're going to be major time soaks, so be realistic about who's going to have the capacity to do this if you don't have resource for it. And you should be clear what messages you're trying to get across and what data you're trying to gather from that initial conversation. Especially if you're screening a large number of companies, you should be focused on gathering enough information to either progress a company forwards or drop it out of your pipeline. So think of it like triaging. And then finally, think about setting some targets around sourcing to meet your overall M&A strategy. So the targets will probably mirror this sourcing pipeline. So things like number of companies identified, how many approached, how many met, and how many go into diligence, and ultimately how many do you buy. It's really important to remember that even with really accurate target identification at the start, a typical conversion rate is going to end up a single figure percentage from your initial list to what you actually buy. So volume can be critical to this working. And to finish on sourcing, I'll give you an example of how we supported a company doing this. So we started working on an acquisition strategy focused on geographical expansion by acquiring similar looking smaller regional competitors. So to do this, we mapped several hundred companies, which we then shortlisted to about 40 that we approached. And of these, we met 24 and have bought 3 over a 4-year period. And initially, we kept all the data in our CRM, and we did the majority of the outreach and screening, with management getting more involved further down the process. But over time, as they realized this was going to be a key, they've hired a team to identify and screen targets themselves, which we helped hire. And they've built their own CRM to track all of this M&A activity, which we helped them design. And with that, in the 4 years since we invested, it's gone from 15 mil revenue to over 50 million now, with M&A being a key value driver in that. I'll hand over to Louise. Louise is going to talk about diligence.
Oh, did you? Oh, sorry, everybody. I've just been speaking on mute for the last 30 seconds, so let me just catch up. For the next 10 minutes, I'm going to talk about the second half of the M&A process. So once you've done the work to identify the targets that you would like to acquire, how do you go about doing the diligence to prove whether or not you should complete those deals, and then ultimately, if you do complete them, integrating that bolt-on into your platform and proving that you've captured value. Let's start with diligence. So is usually putting forward an offer to the target, setting out the terms and conditions that you want, that you would be prepared to acquire their business on. As part of that, You should ask for a period of exclusivity to complete some due diligence, during which the owner of the target company will share some further information with you about the business to allow you to confirm whether or not you want to go ahead and complete a deal. So a normal exclusivity period can be anything you want it to be, but usually a few weeks or a few months. But it's unlikely that a vendor of a business will agree to much more than that. So you need to be really geared up to do all your work very quickly. So by the time you've done a couple of bolt-ons, you'll start to develop your own company playbook for how you approach these, and a bit of a notes for what really matters and how you should prioritise and go about things. But the first time you need to do this, you'll need to develop a DD work programme, and it can be helpful, I find, to think back to your high school science lessons and use the framework that you learnt there for conducting a scientific experiment. So first of all, form a hypothesis, or more likely a long list of hypotheses of things that need to be proven to be true for you to want to go ahead and buy this business. So let's stick with the dentistry example I started on earlier. Some of your hypotheses might be, I want to prove that this dental practice made at least 300 grand EBITDA last year, that at least 50% of its revenue was from private pay customers. The 5 associates that work at that practice are all intending to stay with the practice, and so on. There'll be a long list of those things. Step 2, go out and gather the evidence, the data, to test whether or not these hypotheses are true. So some data will need to come from the company and will be highly sensitive, but then there's going to be a lot of data that you'll just go out and gather yourself through different external data sources, site visits, discussions with industry experts, referencing with customers or suppliers. And then once you've run all of your tests, I think it's quite an important step to pull all your findings together in the round and take a judgment. There will no doubt be a balance of positives and negatives, and this is the point you need to make the call. Do you want to go ahead and do the deal? And then as a final step, don't forget your learnings back into the process to help you appraise your next target. And then when working through the detailed scope of your work for your DD plan, it can be helpful to think of the 5 W's and the 1 H. Again, I'm thinking back to my school days here, but who should do the work? So is it somebody from the platform company management team, or are you going to get a better result by using an independent expert? What exactly do you need to test? So, and what do you not need to test? So keep your brief as tight and focused as possible. Otherwise, you could be pulled down all sorts of avenues that are actually not that useful or interesting. When should each work stream start and end? And it obviously makes sense to prioritise and front load anything that you think could be a possible deal killer. Where should you do the work? So you're probably going to want to spend some time on site to just sort of pick up the feeling and meet people, as many people as you can. But understandably, the owner might not want you to do this because they're trying to keep this discussion under the radar. However, I think you need to just agree what can be achieved. Why are you doing it? And really think about this. The advisors that you engage to help you do diligence will often have it in their own best interest to encourage you to use as broad a scope as possible, and use those advisors because they do this for a living. They'll be able to point out things that might not have been immediately obvious to you. But at the same time, you're paying for this diligence. If something's really not important to you, then don't focus on it, because it's all about proving the hypotheses that you initially went into, and not sort of turning this into a huge exercise of boiling the ocean. And then finally, how are you going to get the work done in the time frame allowed, and are other clever ways to short circuit long exercises. And then finally, in our experience, all of the work you do will end up segmented down into a handful of categories, with the key ones being financial, commercial, legal, and operational. Okay, so moving through the flow chart and on to integration. Now, this can feel like a problem for tomorrow when you're right at the outset of thinking about a buy and build, and understandably so. There's a lot of work to do up front to actually get yourself in the position where you're getting to this stage of integration. But in our experience, it is really important to start thinking about this from day one. And the most successful buy and builds that we've been involved with have gone into certainly at the stage of signing the deal with a very, very clear plan indeed of how they're going to integrate the two businesses. This first point here is simply to point out that post-merger integration is a massive project, and every company needs to work out the best model for them to resource and manage projects like that, just as you would for any other big company project like a warehouse move or a systems change or anything like that. And by that, I mean, you should probably have a plan, a budget, a project sponsor, and a system of reporting and monitoring performance against plan. To my earlier point, be ready with your playbook and be as clear as possible in your own mind about what you're going to do post-acquisition. And depending on the sort of relationship you have with the vendor that you are buying the business from, being very open and planning this out collaboratively with the management of the target company during the DD phase can be really helpful in getting that relationship off to a great start. And if I think about some of our investees and how they've approached this, at one end, where we've been backing a cookie cutter roll up and making multiple very small acquisitions, sometimes one a month, those companies have literally developed physical playbooks that they hand over to the acquisition target and work together post-transaction, running through a series of steps that sort of integrates the necessary parts of the businesses within, say, 3 months. Right through to the other end of the spectrum, take Carousel, for example, which is a pan-European support services roll-up. They've made 3 acquisitions to date, all very different, and in each case, part of the DD process has involved the teams of the platform and the acquisition target working together for a number of months pre-deal to plan a bespoke post-merger integration plan. So unless each bolt-on is going to continue to run really independently, in our experience, the most successful integrations involve people throughout the organisation of the platform and the bolt-on developing a direct relationship with their peer and working together on their integration work streams. This is not a job that can be led completely by one person sitting in the management team. Be careful to protect the value that you've paid for it. Then that seems like a really obvious comment. What do I mean? One of the biggest complaints that I hear from bolt-on company management is that the platform company management don't listen to them and stop them doing things that are important to their success just so that they can fit within a cookie cutter model. Now, there's always a balance to strike here, because part of why you've bought that business is to integrate it with your own, and there needs to be compromise to some extent on both sides. But one tip we've picked up over the years to avoid accidentally throwing any babies out with the bathwater is to work out during the DD phase who the really good people are inside the target company and bring some of them into the integration planning team as early as possible in the process. But hey, change is expected, and that gives you a really valuable window of opportunity to act. Most people, and it's human nature, most people will grumble about change, but it is so much easier to get them to agree to it before you've handed over a big check. And in reality, in our experience, it is a lot harder to drive change when you're many months down the line after the deal's completed. You've lost that sense of deal momentum around the project, and the platform management team have either disappeared or got used to working with you in a certain way that sort of makes it harder to change from. And communication is often the key throughout a lot of this. Pre-deal, you'll probably need to keep things quite quiet for obvious reasons, but you should be ready with your communications plan to launch in the days and weeks post-transaction. Think through exactly who needs to know and actually also who doesn't need to know, and be ready with your specific messaging for every individual audience. And look, I thought this was quite a nice organisation structure model, stolen from BCG, just to illustrate the different functions within a hypothetical post-merger integration office. Now, this is quite a big company view of the world that you'll need to right size for your own business, but I like the way that they have thought about the different functions and purposes of a steering committee who are thinking strategically about the merger and setting the medium-term objectives, versus the project management office who are running the integration project day to day, versus the functional heads and project teams who are collaborating on a peer-to-peer or cross-functional basis between the two businesses to actually execute the integration plan. And finally, just to sort of wrap up the main body of this webinar, thinking about value capture. So what we mean by this is how will you track and report and evidence to yourself and perhaps other people in the future that you have successfully created value through M&A? First point here is around timing. So most of the time, the bolt-on acquisitions that you make are going to be fairly priced in their market, and you're not buying them at a discount or for a super cheap price, because that's life. And hey, if you spot any of those opportunities, you should take them. But most of the time, you will be buying at market value. So you're not going to get the benefit day one of some sort of massive value uplift in your combined business just because you bought it. The value creation will be as a result of the integration and performance of the business under your ownership. The second point is about measurement. So one of the most important things our investees do after acquiring a bolt is very quickly get that target reporting information back up to the platform company in a form that suits them and focuses on those KPIs that are really important. And this can actually sometimes be really difficult to get right. If you're buying small businesses, they're not going to come with a fully resourced finance function most of the time. And one idea that we have seen work well for many of our investees is to actually plant somebody like the financial controller day one into the physical offices of the target and have them ready to go post-transaction, and in terms of getting all the accounting and the cash management systems set up and the local management trained on what it is you want from them. And ultimately, there are three areas that you're going to want to look back on over time to assess whether your acquisition target actually created shareholder value or not. First of all, the standalone performance of the acquisition target. So ignoring any revenue or cost synergies, is that bolt-on company performing roughly in line with the expectations that you set for it before you acquired it? And if it's not, do you understand the variances and either have good reasons for them or a plan to bring them back on plan? Synergies. If you expected to be able to drive out cost or revenue synergies from the target, have you been able to do this? And this is especially important if you were relying on those synergies coming through in order to justify the price that you paid. And finally, no doubt there were certain other factors that you felt were important in justifying the strategic logic of the acquisition, whether that was access to better quality people, a new form of technology, some products, a new market. Have all of these proved to be true in the period post-transaction?
All right, great. Thanks, Louise. So let's quickly wrap things up here with a summary of some of the key themes we talked about today. So firstly, develop a thesis-driven M&A strategy. So while M&A can absolutely be opportunistic at times, your approach should be grounded in a well-defined thesis, which is embedded in your overall corporate strategy. Build a framework to prioritize and manage your pipeline. So as Louis walked us through, it is certainly important to build systems and processes, much like your sales process, to help you manage, track, and prioritize your M&A pipeline. Volume matters. So your success rate will be very low, and you will inevitably have to kiss a few frogs. Having a dedicated resource to get out and meet a high volume of targets is important. Diligence should not be done in a box. As Louise walked us through, you're going to run into issues. It's critical to engage subject matter experts, both internally and externally, so you're fully equipped to diligence all parts of the business and deal. And lastly, integration is key. Many deals have quickly caused more harm than good because the team thought the work was done when the deal closed. In reality, the work is just beginning, and having a structured approach to integration will help. So thank you again to everyone who's still with us. To bring this all together, here at Livingbridge, we have an in-house team of ex-consultants and market experts known as our Growth Acceleration Team, which works closely with our management teams to build a variety of strategic capabilities, one of which is M&A. For our contact details on the page, please do not hesitate to reach out to any of us if you'd like to discuss any of the topics laid out today, or have a live scenario or a question on a problem you're looking to solve with an M&A. We're absolutely happy to hop on the phone and chat through it. I think we're now going to open up to questions.
Yeah, Kurt, the good news is that we do still have quite a lot of people on the webinar, and we've had a small handful of questions come through, which I'm just looking at now.
Great.
So conscious of time, but I think we have 2 or 3 minutes and we'll get through what we can here. The first question, what hires do you need to make in order to support an M&A strategy? Kurt, you've actually done this, haven't you, building an in-house M&A team, so do you want to take that one?
Yeah, sure, happy to. So, there's certainly no one answer fits all for hiring and building an M&A or corporate development team. It will absolutely depend on the M&A strategy you're looking to undertake and the size of your business. If you think about building a strategy where you're going to look to embed M&A into your annual operating plan and strategy, where you may be looking to make 1 or more acquisitions a year, it is absolutely important to think about hiring a dedicated M&A professional to handle the volume of sourcing that's needed to execute transactions year on and year out. As Louis mentioned, it's absolutely a time suck when thinking about building a pipeline of hundreds of potential targets and getting out in the market and meeting with tens and tens of those targets, to find the 1 or 2 that may be interesting each year. On top of that, there'll be lots of time spent meeting with corporate finance advisors and industry experts and diligence providers. So we typically we'll look to find someone who has a mix of good industry experience, a mix of good financial and strategic acumen, but also is quite comfortable in being externally focused and speaking to both C-suite executives, but also senior industry experts.
Okay. Look, I think we've got time for one more question, and mindful of the audience, which is principally, by the looks of things, chief execs and CFOs of businesses that might be thinking about this. I'm going to go for, how do I get started building a pipeline? So, Louis, you do this all day, every day, but for somebody who sees the strategic logic but has not done anything so far, what would you do to get started as the first steps?
Yeah, sure. So what I laid out in the earlier on was more of a desk-based approach, which is great if you have researchers who can put the time in or have kind of done that before. But I think some easy ways to start building up a pipeline would be thinking around like who do you often come up against in pitches, if there's particular customers that you're trying to get access to through acquisition, speaking to them, finding out who they're using. Industry conferences and events can be a great way as well to actually go and start meeting some people, essentially leveraging your network. And then if you're looking at geographical acquisition, so looking at similar businesses but in a different geography, if some of your customers are operating in those geographies, find out who they're using. And so I would say the two kind of options you've got is this desk-based approach, which is really time intensive, and it's always going to be worth doing, but it might not be where you start. Probably lower hanging fruit might be leveraging who you already know in your own customer base already. But I think that, the answer.
Great. Okay, look, I think we're out of time now. Kurt, do you want to wrap us up?
Yeah, so thank you again for everyone for joining. Hope you learned a few things, and as we mentioned, please do not hesitate to reach out to us with any questions. We'd love to hear from you, hear about your M&A strategies and what you're exploring, and if there's any way we can help you, either through introductions or think through the strategy you're considering, or even some fundamentals about how you're building your team, we'd be happy to help. I know there are a few questions we didn't get into. We'll reach out to you directly to answer those questions over the next day or two. So please don't think we forgot about you there. And thanks again. Thanks for joining.